Download this code from codegive.com, link in the description below. OK, let's dive deep into the debt-equity ratio, a critical financial metric for assessing a company's leverage and financial risk. I'll provide a comprehensive explanation, including its purpose, calculation, interpretation, limitations, and practical examples with Python code. Debt-equity ratio, a comprehensive guide. 1. What is the debt-equity ratio? The debt-equity, D/E, ratio is a financial ratio that compares a company's total liabilities, debt, to its shareholders' equity. It provides insight into how much a company relies on debt versus equity financing to fund its operations and growth. In essence, it reveals the proportion of a company's assets that are financed by creditors versus owners. 2. Why is the debt-equity ratio important? Assessing financial leverage. It indicates the extent to which a company is using debt to finance its assets. A higher ratio suggests greater leverage. Evaluating financial risk. Higher debt levels typically increase financial risk. Companies with a high debt-equity ratio may face challenges in meeting their debt obligations, interest payments and principal repayments, especially during economic downturns. Understanding capital structure. It sheds light on the company's overall capital structure, mix of debt and equity. This is essential for investors and creditors to gauge the risk profile of the company. Benchmarking against industry peers. Comparing a company's D/E ratio to those of its competitors in the same industry provides valuable context. Some industries, like utilities, typically have higher D/E ratios than others, such as technology. Predicting financial distress. A consistently increasing D/E ratio may be a warning sign of potential financial difficulties. However, it should be considered in conjunction with other financial metrics and qualitative factors. 3. How to calculate the debt-equity ratio. The formula for the debt-equity ratio is straightforward. Total liabilities. This includes all of a company's obligations to creditors, such as accounts payable, short-term debt, long-term debt, deferred revenue, accrued expenses, other liabilities, shareholders' equity. This represents the owner's stake in the company, calculated as total assets, total liabilities. It typically includes common stock, retained earnings, additional paid-in capital, treasury stock, deducted, other equity components. 4. Where to find the data. The information needed to calculate the debt-equity ratio is found on a company's balance sheet. The balance sheet is one of the three core financial statements, along with the income statement and cash flow statement. 5. Interpreting the debt-equity ratio. The interpretation of the debt-equity ratio depends on various factors, including the industry, company-specific circumstances, and overall economic conditions. Here's a general guideline. Low D/E ratio, example below 0.5 or 1.0. Generally considered less risky. The company relies more on equity financing. May indicate a conservative approach to financing. Potentially missed opportunities to leverage debt for growth, although this can be beneficial during economic downturns. High D/E ratio, example above 2.0 or 3.0. Generally considered riskier. The company relies heavily on debt financing. Higher interest expense and potential for financial distress. Asterisk may indicate aggressive growth strategies. Asterisk D/E ratio of 1.0 asterisk. Asterisk the company's assets are financed equally by debt and equity. Asterisk represents a balance between debt and equity financing. Important considerations asterisk. Asterisk industry differences asterisk different industries have different capital structures. Capital-intensive industries, example manufacturing, utilities, tend to have higher D/E ratios than service-based industries, example software. Asterisk company-specific factors asterisk a company's growth stage, profitability, and cash flow generation capabilities influence its optimal D/E ratio. A rapidly growing company might be able to handle higher debt levels than a mature, slow-growing company. Asterisk economic conditions asterisk interest rates, economic growth, and investor sentiment impact the attractiveness of debt versus equity financing. During periods of low interest rates, companies may be more inclined to take on debt. Asterisk trend analysis asterisk it's crucial to analyze the trend of the D/E ratio over time. A consistently increasing D/E ratio can be a cause for concern. Asterisk qualitative factors asterisk financial ratios should not be considered in isolation. Consider qualitative factors such as management quality, competitive landscape, and regulatory environment. 6. Limitations of the debt-equity ratio asterisk asterisk. Asterisk accounting practices asterisk different accounting methods can affect the reported values of liabilities and equity, making it difficult to compare ratios across companies that use different accounting standards. Asterisk off-balance sheet financing asterisk some companies use off-balance sheet financing techniques, example operating leases, that are not reflected in the reported debt figures, understating the true leverage. Asterisk book value versus market value asterisk the balance sheet values, book values, may not reflect the current market values of assets and liabilities, potentially distorting the D/E ratio. Asterisk ignores maturity structure asterisk the D/E ratio does not consider the maturity structure of debt. A company with a high D/E ratio but a long-term debt profile might be less risky than a company with a lower D/E ratio and significant short-term debt. Asterisk ignores interest rates asterisk the D/E ratio doesn't reveal the interest rates a company is paying on its debt. A high D/E ratio is less concerning if the interest rates are low and the company can comfortably cover its interest payments. Asterisk negative equity asterisk a company with negative equity, total liabilities exceeding total assets, will have a negative D/E ratio, which can be difficult to interpret directly. Asterisk intangible assets asterisk companies with significant intangible assets, example goodwill, patents, may have a lower D/E ratio than companies with more tangible assets, even if they have similar levels of financial leverage. 7. Python code example for calculating and analyzing the debt-equity ratio asterisk asterisk. Here's a Python code example to calculate and analyze the debt-equity ratio using the Finance and Pandas libraries. Explanation of the code asterisk. 1. Get _financial _data, ticker, asterisk. Asterisk this function uses the finance library to fetch the balance sheet data for a given stock ticker. Asterisk it handles potential errors, example data not found, network issues, gracefully. Asterisk returns a pandas data frame containing the balance sheet or none if data retrieval fails. 2. Calculate _debt _equity ratio, balance _sheet, asterisk. Asterisk this function takes the balance sheet data frame as input. Asterisk it extracts the total liabilities and total stockholder equity values. Be careful of the exact naming of the values from the balance sheet, and make the appropriate changes if your ticker has slightly different naming. Asterisk calculates the debt-equity ratio using the formula, total liabilities / shareholders' equity. Asterisk handles the edge case where shareholders' equity is 0 to avoid division by zero errors. Asterisk handles potential key error exceptions if the required data points are not found in the balance sheet. Asterisk returns the calculated debt-equity ratio or none if the calculation fails. 3. Analyze _debt_equity ratio, ticker, asterisk. Asterisk this function takes the calculated debt-equity ratio and the ticker symbol as input. Asterisk provides a basic interpretation of the ratio based on the ranges described earlier, low, moderate, high. Asterisk prints a warning to compare the ratio to industry peers and consider the company's specific circumstances. For example usage asterisk. Asterisk sets the ticker _ symbol to AAPL, Apple Incorporated. Asterisk calls get _financial _data, to retrieve the balance sheet. Asterisk calls calculate _debt _equity ratio, to calculate the ratio. Asterisk calls analyze _debt _equity ratio, to provide an interpretation of the calculated ratio. How to run the code asterisk. 1. Install libraries asterisk. 2. Save the code asterisk. Save the code as a Python file, example debt _equity.py. 3. Run from the command line asterisk. 4. Customize asterisk. Change the ticker _ symbol to analyze different companies. 8. Advanced considerations and enhancements asterisk. Historical analysis asterisk. Modify the code to fetch historical balance sheet data and analyze the D/E ratio trend over time. Industry benchmarking create a function that fetches data for multiple companies in the same industry and compares their D/E ratios. Sensitivity analysis perform sensitivity analysis to assess how changes in key assumptions, example revenue growth, interest rates, might impact the D/E ratio. Debt to assets ratio consider calculating and analyzing the debt to assets ratio as a complementary metric to the D/E ratio. The formula is total liabilities / total assets. Interest coverage ratio another useful metric is the interest coverage ratio, which measures a company's ability to cover its interest expense with its earnings. The formula is EBIT, earnings before interest and taxes, / interest expense. API for live data consider using a more robust financial data API, example Bloomberg, Refinitiv, for real-time data and greater data accuracy. Data validation implement data validation checks to ensure the accuracy and reliability of the financial data. In conclusion the debt-equity ratio is a valuable tool for assessing a company's leverage and financial risk. By understanding its calculation, interpretation, limitations, and industry context, you can gain a better understanding of a company's capital structure and financial health. Remember to use it in conjunction with other financial metrics and qualitative factors for a comprehensive analysis. The Python code example provides a practical starting point for calculating and analyzing the D/E ratio for any publicly traded company. Good luck.